Good morning and thank you for joining us on this special chat. I am Surabhi Upadhyay. We're living in unprecedented times that will not only define history, this milestone period that we are in, but they will also define our future. But as all the gloom and doom surrounds us, it's important to remember that there is going to be a life beyond Corona. There will be a future, and that's exactly why we are here this morning to talk to you about your investment guide, so you can plan for that future, so that you can take advantage of perhaps what is a great wealth creation opportunity. If you're looking at long-term wealth creation, then this is the time to be asking yourself some tough questions. Well, today on the show, over the next 1 hour, you're going to hear lots of big industry voices. We have representations from some of the top AMCs, asset management companies of the country. Not just that, we will also get you inputs from mutual fund research powerhouse Morningstar, and lots of you have been sending us your queries and questions, so we're going to be trying to answer as many as possible over the next 60 minutes. So let's kick it off. My guests on the show to begin with are Radhika Gupta of Edelweiss Mutual Fund, Kalpen Parekh of DSP Investment Managers, A. Balasubramaniam of Birla Sun Life Mutual Fund, and in a bit we will also have with us Ashwini Bhatia of SBI Mutual Fund. SBI Mutual Fund, incidentally, in the last quarter, as per the data that's out, has become the largest mutual fund of India by assets under management. So let's get going. Ladies and gentlemen, thank you very much for joining in. And thank you for doing this on a holiday. You're all at home, and that's the campaign. Stay home, stay safe, but also stay connected. So if I could get first thoughts from the panel, Radhika, we've been going through this turbulent period. What have you noticed when it comes to investor behavior? Whether there are people willing to deploy money, whether redemption pressures are going up, is there nervousness? What are you noticing?
It's actually, hi Surabhi and hi viewers. It's actually, pretty heartening, I would say. I think as far as equities are concerned, investors have remained steady so far. I think March's numbers suggest that. I don't think there's a material change in gross flows. Obviously, for younger investors who've come in after 2008, there is some amount of anxiety. Questions asking, should I stop my SIP? I mean, all the natural questions that will come in because this is your first cycle. I haven't seen, or we haven't seen, heightened redemption pressure as yet. But I do expect that if things continue to be uncertain for a while, that could change, definitely could change. But so far you've seen more maturity than the past, and I think that's a function of the fact that Indian investors are now beginning to see more equity cycles and hence are becoming better and maybe more mature investors. On the fixed income side, a little more nervousness, I would say, particularly around credit, because I think in fixed income we're a little less forgiving.
Okay, well, yes, we are going to discuss both sides of the spectrum, equity and fixed income, as we go along. But Bala, let me get opening thoughts with you. What are you noticing? Have there been redemptions? And if so, where do people want to withdraw their money from? What kind of funds?
Yeah, I think interesting, Surabhi, is basically, as Radhika mentioned, the investors are getting matured day by day. And the common question which you used to get in the past about 10, 12 years back, during these kind of times, the question which will come is, should I redeem or should I invest? And most of the time the question is to come, should I redeem? And this time around, but that question is not there. Generally, people are okay to continue the investment, and people understand is the COVID virus impact on the market. It's quite unprecedented. And at the same time, that people have come for long term. Having said that, I think generally the inflows into the mutual funds is quite large. But given the fact that the last 1 year have been pretty volatile, and the investors have been moving from one fund to other fund, purely on the basis of the performance of last, say, 1 year and 2 years, and they actually let's keep a moving target, the basis of which people keep doing their reallocation of portfolio from one to other. That's why if you look at different industry as a whole, some would have seen redemption, some would have gained market share, and so on and so forth. That's a function of the dynamics of each fund house's performance. Having said that, in the last 1 month, the fall, which is not related to only India, is related to the global market, not one sector, not one stocks. The entire market has fallen. That actually brought all players who would have had that great performance kind of model, they're all brought to a same level. I think now will come at par. Probably it's interesting to see as we move forward would be how the change will happen. But having said that, I think SIP is an asset class, continue to remain an asset class. Though we would have liked the SIP per month book size would have gone to say 10,000 crores per month to the industries and plus. I think broadly the number hovers around 8,800 crores, which of course shows the stability, the maturity of people who have come for long-term investing. At the same time, incremental commitment, which otherwise normally happens in this kind of market, can only pick up as we move forward.
Okay. Okay, Bala. So thanks for the opening remarks. Kalpen, good morning. I need to ask you the same question. Now, Bala gave us a figure. I know the official AMC data is going to come out a little later this week. But do you agree March has largely been as steady? Would you expect that the total equity inflow will still be around 8,000 crores, which is not too bad. In February, I think we were around 10,500 or so. But the big question is whether that can continue. March is also a year-end factor where people are perhaps completing their ELSS investments, etc. What do you anticipate as we step into the new fiscal and the market conditions continue to be fairly rocky?
There are two types of investors in every market cycle, and market is a zero-sum game. One man's crisis is another man's opportunity. So there are people who are redeeming. So in the month of March, new sales were as high as 23,000 crores, but the net sales was roughly around 10,000 crores, which also means that around 13,000 crores worth of equity assets got redeemed. So there are some investors who are going out, and that baton is being taken care by new investors who are coming in. There are enough investors who had some amount of debt in their portfolios waiting to asset allocate. So in round one, my experience of 2008 to 10 phase was that in the first round when markets correct, a lot of money comes in, new money comes in because people feel this is an opportunity. Next round is a function of how things evolve. So if markets rise up without good news, then there will be nervous investors who may say that, okay, let me take some money out. But if markets rise up with good news of resolution of COVID and the lockdowns getting lifted around the world, then there will be stability. If markets fall further, then as in the past cycles before, investors would get more nervous and try and reduce their exposure. So these are the three outcomes. My sense is a bit early, maybe 2-3 weeks down the line, we'll get to know how each of these variables are playing out, and that will give us a signal of what trends we expect in the future.
Okay, now let's get a view from the largest mutual fund house of India by assets under management, and I'm talking about SBI Mutual Fund. Mr. Ashwini Bhatia has joined in. Mr. Bhatia, this is what we're all discussing, that it's good to know that in March investors, specifically if you talk about equity, they kept the faith. But do you think this trend can last? And then there's a wider market question as well, that can mutual funds keep supporting the market and keep absorbing the level of FII selling that we've seen? What's your sense as we go further down into April?
So the good thing that we have seen over the last 3 months is that our domestic investors have kept the faith. All the selling that has happened over the last, I think, mostly in March, that was on account, and the fall that we've seen is on account of the fact that FIIs have exited. So in January and February, in equities at least, they had invested about $1.5 billion. In March, they exited about $7 billion. So it has been absorbed very well. And you should also think, now how long can FIIs also sell? Now, everybody is trying to run. Is it possible to run? I don't think so. Talking about the domestic flows have been steady. What we are telling our investors is that keep the faith, add more units, don't cancel out your SIPs at this time. This is not the right time. This is the time to accumulate. And I mean, I have seen falls in 1998, 2001, 2004, 2008, 13, 16. And of course, this perhaps could be a little deeper because there's an economic dislocation, if I may use that word. But anybody who has stayed invested hasn't been disappointed at this point of time. We have been getting calls from a lot of anxious investors. What we are telling them is this is the right time to enter. Enter gradually. Maybe you should put in about 10, 20%. If we were telling customers to look, do SIPs now, we tell them that, look, start with lump sums, then continue with your SIPs. That way you'll get much better returns. But anybody who's a long-term investor, next 3 years is a golden period to my mind.
Okay, well, we're going to debate this as we go along, because I just randomly looked at some basic data, annualized return data, and we'll try and put that up as we start with the viewer questions as well. And it's a little shocking, I must say. If you're looking at the last 3 years or the last 5 years, then actually debt funds have done better than equity funds. We'll pull up those slides for you as we go along. It's actually gilt funds that have done better, 10-year government bond funds that have done better, even PSU banking debt funds have done better. If you're looking at the worst performing funds, and all the equity names come in over there, the fall in banking stocks has been so severe that the banking sectoral funds are actually down even on a 5-year basis. There are infrastructure funds, other thematic funds that have anyway suffered. So largely speaking, equity funds are in the worst performing category in 5 years, and debt has done better. We'll get you more analysis as we go along. Let's get to the queries, because people are asking lots of pertinent questions. The first one is coming in from Harpreet Singh, and here's his question. He says, I'm a first-time investor. I've always invested only in post office schemes, FDs and RDs. Should I invest now? Please advise an investment for the next 10 years. Now, Radhika, this is the big one, right? And again, if I look at data, 10-year returns, it was something to note that mid-cap funds have given you a CAGR of at least 9 to 10%. Large cap funds, multi-cap funds, we're talking CAGR returns of just about 5.5–6%. So now for a first-time investor, is this the time to get in?
So I have 2 points to this. One is that I think it's a little unfair to look at equity data after a 30–40% correction in markets and to compare it to fixed income data after a significant cut in rates. I mean, you're really looking at equity funds at their worst point. My view is, don't look at the numbers at their worst point. Don't look at the numbers after a 30% rise. Look at the average. So this is not a fair point for comparison, because you'll never be an equity investor if you look at the numbers at the bottom of the cycle. As far as a first-time investor is concerned, it is a good time to get into equities if he does have a 10-year horizon. He has to remember, though, that if he is a first-time investor, that he will see cycles. This is not the only time equity markets are going to fall 30%. They may fall 30% next year. They may fall 30% further. So that's something you need to calibrate, and basis that he needs to calibrate how much he wants to do in equities so that he's comfortable. It's very easy to say, I want to jump into equities when this is the time. But a 20–30% correction for most first-time investors really tests your holding power. So my advice to him would be, of course, get started, but take baby steps. He can take baby steps by allocating gradually to equities. He can also take baby steps by allocating to funds that have partial amounts in equities, like dynamic asset allocation funds, etc. Because the straight switch from post office to equities is a pretty extreme test of anybody's risk appetite.
Okay, all right. So there you go. That's some advice coming in. It's a big leap from post office deposits to equity, so you might want a staggered approach. The second question that we're taking up today is coming in from Manish Jain. And he is asking the question that everybody has on their mind. Is this a great time? Is this the perfect time for lump sum investment, or should I simply keep going with SIPs? Kalpen, this one to you. And we're trying to keep answers short so we can answer lots and lots of queries.
See, if you were an investor with a 50-50 asset allocation 1 month back in equity and debt, today it has become 35-65. 35 in equity and 65 in debt, because equity prices have fallen and debt is same or marginally higher. So the first thing one should do is to normalize your asset allocation and move from 35 to 50 again, if you have your right time horizon. My assumption is that Manish has a long time horizon. That is why in the first place he's talking of equity. So the first step is to normalize your asset allocation and come back to 50-50. Number 2, personally, I would still go with SIPs for the simple reason that markets have fallen from their peaks, from their highest valuations. They are closer to average valuations. They are not closer to their all-time low valuations. So they will continue to oscillate, and the economic data points are not yet known. We are still very early in this cycle. we don't know the future, and hence SIP is designed for environments like this where we don't know the future. We keep acquiring more and more units. Units acquired in 2008, 9, 10, even today, if we look back at their returns, will be 2 to 4 times higher. So would have multiplied 2 to 4 times in a crisis phase like 2008, 9, and 10. So I would encourage, first step, normalize your asset allocation back to what it was before the correction, and second step, increase it further using an SIP.
Okay, there you go. So that's some perspective. Ranjit Jha, let's take up his question because, this kind of encapsulates the fear that's also out there. Ranjit Jha tweets to us and asks, is this the best time to exit mutual funds completely and come back after 6 months if we survive this corona? Now, it sounds, it's as if it's been asked in jest, but Mr. Bhatia, this is a genuine concern. A lot of people are saying, let's just forget our investments and come back and have a relook once the world settles. What would you say to people who have such worries?
So I don't subscribe to the doomsday scenario. This is not. I think as a nation, we have done much better than others. As I said earlier, this is the right time to change your allocations. So if this gentleman, Mr. Jha, was or is in equity, he should keep his faith and at this point of time increase his allocation a bit. Maybe if he's not too sure about the markets, he can get into a liquid scheme, and through the liquid scheme try to do some kind of STP over the next 6 months or so. But to my mind, this is a good entry point.
Okay, all right. Well, stay right there. Our panel of experts is also going to continue. We take a very quick break. More of your questions answered on the other side. Welcome back. You are your investment guide, and we have a whole panel of experts and representation from some of the biggest asset management companies in this country to talk directly to investors and help you navigate what has been a very, very turbulent time in the market as well. Okay, we've got a couple of questions coming in on ETFs, which have become very, very interesting and exciting products in the last couple of years. They're huge globally, and they seem to be gaining popularity here in India. Now, let's go to the questions straight away. Jayshan asks us, is this the best time to invest in an index fund? That's Jayshan's query, and let me take another query on the same topic. I believe we have another one which is coming in from Indian by Heart, saying that kindly publish or inform us a little bit about ETFs, publish some information or inform us about ETFs in India. Now, Bala, it's quite interesting, right? And why not ETFs? Because they are extremely low-cost products. And when, again, I don't want to sort of harbor on this, but if actively managed funds, CAGR, are going to give you, single-digit returns, then why shouldn't you look at an ETF as well? What would you say to viewers who want to know more about exchange-traded funds?
Yeah, of course. Interestingly, globally, the ETF as a product is picking up, and then nobody wants to take a bet on actively managed funds. They can, of course, choose to invest in ETF index funds. Having said that, I think the point which we also made earlier, I think when you believe the principle of asset allocation, then naturally you need to have actively managed funds where the money managers, especially the market has fallen so much, the money manager's ability to generate alpha over a long period of time over the index will still remain high. And given the bigger market size that we have, and money managers will find enough opportunity actually to pick stocks in the long run to generate outperformance in the actively managed funds. Therefore, from investor's point of view, while ETF is not a bad product, but it has to be part of the asset allocation. You can choose some funds and actively managed funds, and then some bit of an ETF fund or index funds.
Okay, well, there you go. That's a view on ETFs. There's a question that we've even got on global funds. So obviously investors want some diversification. Let me go to one of the queries. I'm quickly trying to sift through this. Amit Maheshwari has sent us a question, and now Amit is saying, what is the best way for Indian residents to invest in US stocks or the US index? I'm not sure about the expense ratio of some of these funds which are offered by Indian mutual fund houses. Actually, lots of Indian AMCs are offering these funds. Radhika, if you could take this up, I know Edelweiss has some of these funds as well. What kind of inflows have you been seeing? And do answer this gentleman's query also about the costs involved if you want to invest in global equities via an Indian fund.
So quickly, I think global equities I've always believed should be a big part of the portfolio, or at least some part of the portfolio, for two reasons. One, they give you international diversification. India is not the only market that performs. In fact, if you look across years, every year you'll see a different market being the best and worst performing market. So it's very important to diversify. And secondly, global funds also give you that very important currency hedge, because at a time like this you also see the currency under pressure, and this is true in all past crises. Now, how to access global funds? In the Indian context, through mutual funds, you can actually access funds of most global markets. At Edelweiss, we have 6 funds, and I think across the industry, you can probably access 80 to 90% of the world's markets through global funds, actively managed funds and passively managed funds. There is a myth that costs are much higher when you go for an international fund in India. That's not true. The regulator caps costs at 2.25% plus taxes. That is including the cost of the global asset manager. So take what the India asset manager charges plus the global asset manager, and your fees are comparable to a full India equity fund. In fact, we see that in the case of many of our funds, Indian investors, because of our regulations, pay less for the funds than their counterparts pay for some of those funds overseas. So I think cost is not something that investors should keep in mind, and it really actually is the most efficient route. From a convenience point of view, it doesn't have the withdrawal tax, etc., to get global exposure. And as I said, all the major markets are accessible.
Okay, so there you go. Those are some thoughts on some of the foreign equity funds that we can invest in sitting right here in India in Indian rupees. Now, ladies and gentlemen, we've spent quite a bit of time talking about equity funds. I also want to get your thoughts on fixed income, because what has happened is just when the retail investor was looking for an alternative to his fixed deposits, there's been so much turbulence in the fixed income market. We've had a period where even liquid funds have turned negative, and there are so many credit risk events, so many blowouts that have happened. How should one approach the fixed income market? Kalpen, you want to take that?
So first of all, Surabhi, let me make the statement very clear. Markets fluctuate, asset classes fluctuate. If any investor is coming in to invest in equities or bonds or debt funds or equity funds or global funds, fluctuation is the character of the game. So if you cannot digest fluctuation, this is not the right category. Fluctuations will be there, the degrees will change. Secondly, some of these fluctuations are temporary, but they stay in our memory, and they hold us back from doing our right asset allocation. In my view, what has happened globally, for example, interest rates have gone to zero. In India, interest rates from 9% have come down to around 6%. And to support the economy, all central banks, including India, are creating huge amount of liquidity and keeping interest rates low, and likely to keep them lower for some more time. When we see a phase like this, bond funds tend to do very well. And there are cycles when interest rates come down and they go up. My advice to investors who want to invest in fixed income as an alternative to fixed deposit is to look for debt funds which have similar risk profile like a fixed deposit, which means average maturities of 1 to 2 years, risk profile or credit rating which is as good as traditional bank deposits or public sector bond deposits. And a category of fund called the banking PSU fund or the short-term debt fund or the rundown, roll-down funds, these category of funds allow you to get an experience very similar to fixed deposit. And if you stay invested for 3 years and above, you are also able to get tax advantage of double indexation. So I would, if there is one fund to recommend or one category to recommend to investors, it would be the short-term fund category.
Okay, now we have very little time left. I'm going to shoot two quick questions. The first one is very simple. I always ask when mutual fund top bosses, join us on our shows, I always ask them to put their money where their mouth is. So I'm going to ask you that if you were to invest your own money in maybe your own funds, your own universe, or some of your peer groups, give us the one or two top funds where you would make a lump sum investment today. Radhika, I'm going to start with you.
My own, it's very easy. Edelweiss Balanced Advantage Fund. I'm a moderate risk profile investor. I like the mix of equity and debt, and I don't have to worry about how much goes where. So it does it automatically for me.
Okay, Mr. Bhatia, if you were to pick one or two funds for a lump sum investment?
I'll put it into SBI focused equity, and I will also put some money into multi-cap. It's going to be full equity from here.
Okay, full equity for Mr. Bhatia. Bala, what about you?
Of course, I have 100% of my money only with Sun Life Mutual Fund, my own fund, and I'll invest between Focus Equity Fund and Sun Life Equity, which is a multi-cap fund. And I'm also, of course, believer of asset allocations, banking PSU fund, money market funds among the debt funds.
Okay, so some debt and some equity. Kalpit, your top choice.
55% currently equity fund, around 30% debt funds, around 10% in gold, and 5% in passive Nifty and Nifty Next. This is my current asset allocation. 55 will move to 65 in the course of next 1 year.
Okay, as we are winding up, since we're a little short on time, Mr. Bhatia, I'm going to come with you. I mean, since you do represent the largest fund house, if you could just, voice the industry's concerns as well. Before we let you gentlemen and ladies go, there's a lot that's happened from a regulatory perspective, certain compliances, you've got to push back for about 3 months. The RBI has done a TLTRO. Just purely from a business continuity perspective, dealing with market volatility perspective, is there anything else that you would like to see from the regulators, whether it's SEBI or Reserve Bank of India? Mr. Bhatia?
So let's take RBI first. I think the kind of push that we got from RBI a few days back was much needed. So on the CRR front, on the targeted LTRO, on liquidity reduction in repo, reverse repo, so on and so forth. So whatever you wanted, I mean, you've got a liquidity push of about 3.7 lakh crores, which under the circumstances is big. Now, RBI is today dealing with a trilemma, so on exchange rates, on liquidity, on monetary policy. So I think within the limitations, they've done a great job. SEBI also has acted, and it has delayed certain compliances, and on a daily basis, we are also part of AMC. So SEBI is acting on a daily basis. But today we have a moving target, to tell you very frankly. And to just say that A should do this or one regulator should do this may not be the right thing. We have a moving target. But I think whatever we have got so far from the regulators, they have acted in time. One thing, of course, always uppermost on my mind is the fact that none of the institutions should be allowed to fail. Look, over the last 1.5 years, you've seen the failure of, ILFS, you've seen DHFL go down. We can't see any more failures happening, and, industry suffering in whatever way that you've had. So I think it is necessary that we come together as a group. But as far as SEBI and RBI is concerned, they have been acting in a very timely manner.
All right. Okay. Thank you very much, Radhika, Mr. Bhatia, Bala, and Kalpit for joining in and giving us your thoughts on how mutual funds are weathering the storm, and of course advice to our investors. Thank you very much for being with us. Well, we need to take a break on that note, but don't go anywhere, because we have a view from Morningstar coming up. Kaustav Velapurkar is going to join in to tell us what's the Morningstar model mutual fund portfolio looking like, and he'll also answer more of your questions.